The gold-silver ratio, you might have heard of it. It's like a scoreboard. It tells you how many ounces of silver will buy 1 ounce of gold. Why should you care? Well, simply because it helps you to care. The ratio helps you read the mood of the market without necessarily having to stare at charts all day. Because as you know, gold acts as a safety anchor, while silver is part safety, but part industrial. And that's what makes this so important. And here's the thing, you don't even need exact numbers to know how to use it. You really only need to know which way the tug of war is pulling and why, because that's the most important thing, the why. So here's what you'll get in this video if you stick to the end. I'm going to show the 3 levers that push the ratio around and how to read them simply. I'll also give you a simple playbook so you can stop guessing and start noticing real patterns. It's important to understand we're not chasing so-called perfect levels, no. And we're not just going to pretend the ratio guarantees anything. And of course, this is not financial advice. We're using it much more as a guide, as it should be used, in the same way that a compass points north. But you've got to decide how to get there. So if you stay with me, you'll end up with a 60-second toolkit you can use all year round to understand what's going on in the market in general, but especially with gold and silver. Now, as promised, let's look at the 3 levers that move the ratio. Think of them like the control panel, a dimmer switch, a pressure gauge, and an engine meter. Lever 1 is the real yields. For those who don't know, that's basically interest minus inflation. When the real yields rise, safe assets often look more rewarding. You got to also remember, think of it from the perspective of a big institution. Then this will start to make a lot more sense. If you're thinking about yields from a government bond, for example, as a small investor, as a retail investor, you're going to think, well, 5%, 4%, 3%, 6%, it's not really large numbers. But if you have, let's just say $100 million in some sort of fund or a pension fund, then obviously it makes sense to look at the yields a lot more. Not just for guessing the market, but for actually like the return on your portfolio. So essentially, depending on the level of the yield, gold's store of value becomes more appealing or less appealing. When real yields fall, the pressure eases and gold often finds support. Because as I said, silver is part industry, but also part hedge. Yes, people do stack silver as well as gold. I'm sure many of you probably do, which is cool. I'm more of a gold lover, but I like silver. Because silver is part industry and part hedge, shifts in real yields can tilt the tug of war between them. Lever number 2 is the US dollar. Yes, the US dollar. You were probably expecting that, I suspect. As you know, most global metals are priced in US dollars, at least for now. A stronger dollar is almost like more gravity. It sort of weighs in on prices and therefore makes it harder for buyers outside the US in foreign currency to purchase gold. However, the opposite is also true. A weaker dollar is like lighter gravity, which can help demand. Now, of course, the dollar doesn't control every tick, but it's basically the pressure gauge that tells you how hard the wind is blowing. Lever 3 is the growth pulse. So when the economy's engine sounds healthy, think for example, better factory surveys, firmer demand, silver's industrial side matters a lot more, and therefore the ratio can start to fall as silver outruns gold. However, when growth looks soft, people lean back towards safety, and the ratio can climb as money flows back into gold. And that's the 3 levers. Real yields set the background cost of holding safety, the dollar sets global buying power, and the growth pulse decides how much industry matters right now. The best part is you don't need a PhD to even use this. It's quite straightforward once you understand what's going on. All you have to do is just ask, are real yields easing? Is the dollar relaxing or firming? And is growth overall soft or is it firm? Next, let's look at how these levers have showed up across history. Here, I'm going to give you a quick mental model for the gold-silver ratio across time. Don't memorize dates, just try and think of it as the weather. When the ratio is high, the weather is usually risk off. That means essentially the world is nervous, growth looks soft, or the dollar is firm. In that mood, people lean on gold's safety job, and therefore silver's industrial side matters a lot less. Essentially, a high ratio basically means gold has the upper hand. However, when the ratio sits in the middle, it gets a little bit more complicated. Even what the middle is will depend as well, as we've seen it rise a lot in the last couple of years particularly. When the ratio is in the middle, the weather is mixed. It's half cloudy, sort of gonna rain. It's one of those situations. You know when you want to do something but you're not sure if it's gonna rain, so think of it like that. So some of the data might look okay, but some might look soft. In that range, you'll often see back and forth stretches. Silver tries to run when growth whispers maybe, but then stalls if yields of the dollar push back. Mid-ratio basically means the tug of war is undecided. Now, when the ratio is low, the weather is risk on because growth looks healthier, factories are busier, and of course, investors are willing to take on more risk. That's very important. In this case, silver's industrial demand is getting stronger, so it can outrun gold. A low ratio basically says silver is doing the lifting. And there's one more very important point I'd like to mention. People often talk about mean reversion, as if the ratio must magically just snap back to some sort of predefined number or to some sacred level. It doesn't actually have to. And as one commenter pointed out, it's reasonable to say the ratio is at a new level, a new range. The world changes. Policy regimes shift. Technology shifts. Technology shifts silver's demand over time. Mining costs and supply mix evolve. These slow structural moves can nudge what the new normal looks like. I was talking to a commenter about this topic, so it's in one of my videos, but it was a very good commenter. So if anyone's watching this and wants to comment something, please do. I enjoy talking to you guys. So essentially what I'm saying is just don't worship a blind number, which I'm sure you're not, most likely doing that, but just in case. Ask which way real yields, the dollar, and the growth pulse are pointing, and then see if the ratio is behaving in line with that story. If the ratio and the weather disagree, be cautious, because sometimes the best trade you take is no trade at all. Now let's turn this new knowledge into a scenarios playbook. When does silver actually outrun gold, and when does it not? So here's how the ratio usually behaves in real world situations. The best way to think of it is if this, then likely that, maybe, that type of thing. As you know, nothing is definitive in these situations. If growth looks shaky and headlines feel tense, gold tends to lead. The ratio often rises because people want the safety anchor first, and therefore silver's industrial demand goes quiet. That's the classic risk-off stretch I was talking about earlier. If growth firms up, factories are busier, confidence less fragile, silver can outrun gold. The ratio often falls as that hybrid metal behaves more like turbo gold. It doesn't need a boom, it just needs to fear the ease. Say if the dollar jumps fast, both metals can struggle in US terms because global buyers face heavy gravity. However, it's important to note that silver normally feels this gravity a lot more over time, so the ratio could rise. But when the dollar falls, that pressure lifts. If real yields climb, holding safety gets more expensive, and the ratio can tilt towards gold. If real yields ease, that pressure fades and silver gets a fairer shot. Energy shocks are particularly special. Say if oil spikes on a supply scare, inflation fear can actually lift gold, but growth worry can weigh on silver. That's why it's important to look at everything that's going on in the world as much as you can, because those cross currents often push the ratio up. And of course, if energy calms, the opposite can also happen. Now, of course, physical demand also matters a lot too. Firm local premiums in big buying markets say the real buyers are here, which importantly can help hold the metals during dips. You've probably seen this a lot if you trade gold, because that's usually the central banks buying underneath all this. And I think to some degree you see it with Bitcoin as well, but I'm not 100% sure, but I think a lot of the institutions are also buying that. But anyway, I don't know if people on this channel even want to hear about crypto, so if you do, let me know. I'd love to talk about it, to be honest. But anyway, so let's talk about two quick rules. When all three of those levers point the same, the story of course is going to be a lot cleaner. When they disagree, chop and fake outs are very common. So I want to very much emphasize, read the weather itself, not just a number. Next, let's hit on some traps and some myths that can cost people the most and how to avoid them. The first trap is of course worshipping a number. You might hear some people say, oh, the ratio just must snap to a certain number. It really doesn't have to. The ratio moves with the real world, and the real world is changing very fast, as you all know. With policy, growth, industry, and currency, not a magic line. Remember, the lines on the chart just represent something that's happening in the real world. The second trap is overtrading tiny moves. This may not apply to you if you're just a long-term holder, but the ratio, like anything in the markets, wiggles all the time. If you react to every single flicker, you'll pay spreads and fees and take on maybe higher risk and churn your account and maybe even miss the bigger swing. And don't worry, we've all been guilty of some sort of trading issue at some point, so no judgment here. That's how you learn, I guess, especially if you're on a demo account. So let the three checks guide you. When the levers disagree, chop is normal. Doing less is itself a decision. Here's a third trap: leverage without rules. We saw this recently in the crypto crash, over leveraging. If you're trading products like options, futures, or CFDs, depending on where in the world you are, one bad behavior can theoretically erase months of progress. I'm not just talking about drawdown, I'm saying you can make one bad choice if you're not careful and with managing your risk. I tend to be the opposite, I tend to be too careful, but that's just me. If you ever do use leverage or any of these products, set size, a stop, and a time limit before you click. If you can't name those three before you get into the trade, then I'd really advise not to do the trade, not to click it, or not to use leverage. And here's a fourth trap: mixing timeframes. A long-term thesis with short-term exits is a fast way to panic. Decide before you start. Am I holding a core, tilting for a few months, or trading a short window? Let that choice set your pace. Fifth trap is just using the ratio alone. It's more like a compass, not a GPS. Add simple context, real yields, the dollar tone, and the growth pulse. If the ratio says one thing and the levers say another thing, maybe trust the levers. Final trap is ignoring friction. Premiums, spreads, funding, even taxes depending on where you live. Even shipping or custody depending on how you're buying the gold, whether it's paper gold or whether it's in a vault. All these little costs can compound, storage, that type of thing. So know them before you chase a smart swap. But I'm sure you probably already know this if you're holding a lot of gold. With the traps out of the way, before you touch anything, ask yourself two simple questions. First, ask yourself, what could change the ratio from its current point? List the real levers, not just the wishful ones you want to see. Be honest, are the real yields likely to change? Is the dollar more likely to relax or firm? Is the growth pulse really softer or getting stronger? Write the answer as though you're giving it to a friend. If you can't name a believable change, then simply probably don't act. If you can, even say what you'd need to see to admit that change isn't happening. The second thing is, what if I'm wrong for 3 months? Not forever, just a normal patch of being early. Can you live with the swings? I know it's easier said than done depending on what you're doing. Understand the fees, the spreads, and funding costs. Does it make it painful to hold? If news flips the story, can you exit quickly and cleanly? If the only way out is a panic sell, the tool is wrong for the job, as we have seen in the crypto crash, if you've followed that. I'm not sure if gold people like crypto, but I think crypto people like gold, and I don't think gold people like crypto. I could be wrong on that, but comment and let me know. I'd love to know. I'd love to hear from people. I want to make this channel like fun. We can talk, about this stuff. That's the whole point. I'm not an AI channel. I'm a real human. You can actually talk to me. All right. Also, if you've got some sort of trade or a position on and it keeps you up and it keeps you stressed, the size is most likely wrong. So turn those two questions into a tiny, actionable plan. If the levers do align, scale in slowly. If the levers conflict, maybe wait. If the story breaks, cut it and move on, because it's going to work perfectly. Using these strategies isn't about being perfect. It's basically about setting rules, understanding what's going on so you can remain calm when the market is not, especially when it goes against you or not what you expected. It's when you're aware of what can change the ratio and what you'll do if you're early, you're realistically playing a game you could probably actually win. Next, as promised, I'll give you the 60-second toolkit that you can reuse time and time again. Step 1 of the process, read the 3 levers. If real yields are easing, the dollar is cooling, and growth is firming, the ratio has a downward bias, and therefore silver usually does a lot of the running. If real yields are rising, or the dollar is jumping, or growth is soft, the ratio has an upward bias, and therefore gold usually does most of the work. If the levers disagree, expect chop. Do less or even wait. Step 2, confirm with quick signals. Look at the physical demand. Are local premiums in big markets firm? That suggests real buyers on dips. Look at investor flows. Are gold and silver funds seeing steady inflows? Because these quiet forces in the background do actually matter quite a lot. Step 3, match the tool to the idea. If you just want core exposure, such as maybe owning the physical metal itself, it's a very simple process and quite low maintenance. If you're on a medium tilt, perhaps scale in and scale out slowly when all 3 levers align. If you're doing short tactical trades, well, there's nothing I can do to help you. No, I'm kidding. If you're doing short tactical trades, use a small size with a preset exit and maybe even a time limit. Step 4, count the friction. Understand the spreads, the fees, the premiums, even taxes. It's a bug, because small costs can compound. Know them first. Step 5, write a one-line plan. If X happens, I'll add or I'll trim, for example. If Y happens, I'm wrong and I'll exit. I know this might sound a bit simple, but believe writing it out actually helps quite a lot, to be honest. Especially if you have a mind that can be distressed by changes in the market. Try and think in segments rather than all in and all out. Do this the same way every time, and the ratio becomes much more of a guide, not a gamble, and in no time you most likely will become much better at this. I hope you got something out of this video, and if so, please subscribe. Thank you very much for watching, and let me know if you'd like to see anything covered. Thank you.